Quick disclaimer, these videos are meant for educational purposes only. Anything said or shown in any of these videos are personal opinion and my perspective. Trading carries a high level of risk, so anything done is your responsibility. Hey, how's it going, guys, and welcome back to mentfx. Now today, I want to talk about accumulation models, truly understanding when a market is ready for markup, how to use tools to actually see that firsthand, use baskets and utilize baskets to understand which markets are ripe for potential large moves if money comes in, and how you can personally get positioned so you can do well for yourself. Now, before we get started, two things are going to happen. One is I'm going to show you a clip from our private mentorship webinar that happened this Sunday when silver, the market we're currently looking at right here, was at these points and exactly where I spoke about how its relative strength in regards to gold would mean that further climbing in this market and a run on the next high would likely result in a trending based stage 2 markup that would result in a large explosion higher, as you can see right now on your screens. So I'm going to play that for you right now. You're going to see firsthand how we discussed it, how we spoke about it prior to it all happening, and then we're going to get back here and talk about what's going on. So silver's not on the sentiment. I'll add that for you this week, but let's go look at silver. Bro, it looks like gold. A lot of back and forth right now. Likely an accumulation. That's good. Let this accumulation start playing out. It kind of is, right? SSC. I mean, look how wicky it is, though. This is not a market that I would want to trade right now. But SSC is starting to play out. You know, you have clearly a surfer happening right now. So there's some accumulation there. So like, if this starts going, you know, again, it's all in the same thing. But yeah, you can start seeing some bullishness on this. That's all I'd look for on this. And it's definitely more, look at the relative strength. It's insane. Look at gold. MB's bearish, makes one little push bullish and breaks down and can't even push beyond the bullish. And this one makes that bullish push multiple times, right? Comes down, but they can't even get below the low. Yeah, so this thing is, look at this. Gold takes out its low. This can't take out the low. This is super strong in relation to gold. So like, if money can come in, this is going to make a really strong move. The relative strength on this thing is so strong right now, right? So it's showing you that, at least, which is good. Yeah, I mean, if this bullish model starts playing out, you can watch for those. Might put this on my watch list, to be honest. I'll throw gold down here, because honestly, it's not terrible, and if it can start doing something clean, I can definitely start to follow it. So we'll see how that goes. But it's being able to look at something like EU and identify that there's nothing to touch here, even if your system is met, right? Because at the moment, there's just no money has proven what it wants to do. This is where people get chopped up in the markets. Hopefully now you've seen that portion of the webinar where we discussed silver specifically. And what I want to do before I go a little bit further right now is I want to talk to a few of you and show you the sentiment viewer, which is still in beta and fully free to utilize at the moment. If you go ahead to the sentiment viewer by going to mentfx.com and going over to more in the sentiment viewer right here, what you're going to see now is a daily overall institutional money and how it's moving in the market, and you're also going to see an intraday. This is a very, very easy way for you to pair your analysis with the underlying money. And oftentimes, if you can allow the context or the actual market analysis to tie with the sentiment, you're going to have a married direction that is likely to be very, very powerful. So if I go right now to silver, as you can see right here, even though the daily is overall bearish, despite that, the intraday remains extremely bullish. Now, when I began trading this at the beginning of the week on Monday, all the way up until today, which is Wednesday, this number right here was not 100%. This one's going to change a lot more because it's intraday. This number was around the 60%, around these points here. As the week went on, it was about 70, 80% here, and it's risen to around 100% from this morning. So this trade right here was a very, very easy one. Sadly, you can see here it was not able to run. We're going to talk about all these in a second, but the intraday has been added to this overall thing. So now you can utilize your contexts, make sure they line up with the actual money that's inside the market, and then get involved. It's just another confluence tool to give you the to give you the confidence to actually start entering on trades that are good trades, but also to link up good context, right? So for instance, a good example is Euro US dollar. I have not touched Euro US dollar ever since this breakdown right here. You can see near the beginning of last week, around Thursday, the 3rd of August, price began to make an accumulation model, something we're going to be talking about today. Began to hold that accumulation model, started delivering the 2.0s, hadn't really started a full-on run on this high yet. It began to run it and then instantly snap back without pushing through it with a displacement. I believe this was on a 1-hour chart. There you are. And from there, the most recent 2.0 buildup, simply following the last down moves before the up moves, failed to withstand, failed to hold, and broke down. And ever since this candle right here that broke down this move right here, I have not looked at Euro US dollar once for any trades. Now, before I proceed further, it's been about 12 days since I've looked at EU, right? I haven't really touched it once. And one of the main things I want you to take out of this video as you're watching it is that you cannot get yourself attached to any one market. It's super useless unless you trade a 1 minute or sub time frame where every day you're just like trying to take a tiny pip out of the market and that's all you're doing. Maybe you're trading less than a, $10,000 account and you're fine with doing that. Then that's fine. You can trade one market. But you need to learn to basically listen to the heartbeat of the market. The market is cyclical in that money flows in and out of it every single day from pair to pair, from asset to asset, and different markets at different times are going to be in clear markup or markdowns or in weak to strong hand transfer. Currently, Euro US dollar is in what we call a weak to strong hand transfer, which means most of the time, Euro US dollar is going to be going up and down, back and forth, and no matter what side of the market you attempt to get positioned on, the odds of you getting a running trade that doesn't instantly take you out or stop you at break even or make you have a loss is very, very low, because these are the conditions that are not optimal for a good trending based system. Which leads me to one of the next points I want to talk about, which is understanding when your system or criteria fails. Every single good criteria in the world that you can trade to make millions of dollars has times in the market that are not optimal for it to be used. The reason a criteria is good or can make you money is because you as a trader understand when it's worthy of putting your risk onto a given market. If you don't have a way to analyze the market and understand when it's right for setups or not optimal for setups, then you are going to find yourself losing and staying confused long term. Those are the kind of people that are consistently confused by the fact that sometimes the market's doing great and they're doing amazing, and sometimes they're losing everything and they remain break-even traders. Most traders that make their way from being fully losing traders to break-even traders are traders that have not taken the time to understand how contexts in the market develop and then sustain those moves for when their entry criteria is the most optimal. Every criteria in the world that is traded from, let's say, a 15-minute, 5-minute time frame or higher is only going to be optimal in specific scenarios of the market. These can be very simple scenarios. Some of the best traders in the world use something as simple as a 200 MA to decide that. Or they can be a little bit more complex and deal with more nuance, as the mentfx methodology teaches, which is understanding how markets are accumulating and if they're accumulating or distributing, whether you're in a phase of accumulation or distribution, whether the higher timeframes or multi-timeframes agree with those things, whether the baskets of all those things are in agreement as well, and whether you're actually in a markup or a markdown versus just a back and forth environment. So looking at Euro US dollar here, instead of being able to sustain its bullish pushes initially, and then from these points here to continue making a move upwards that could then sustain a move higher and higher and higher, it continued to go back and forth, failed to push through, and started breaking down. And since that point right here, without proof that it can go long, there's been nothing for me to watch on EU except to sit on the sidelines. And something to take note of that's very important is that as we're looking at this here, you can notice, hopefully you notice, that every single zone that I have drawn onto the chart here is not instantly met with a respected entry, nor is it met with any disgust or loss of confidence in the fact that the zones might be failing. Zones on the charts that you're utilizing are not meant to hold. They are a footprint. And footprints are there to show you that there may be something you can find, but it does not give you the indication that it's already there and ready. This is why many of the things online are keeping you in a cyclical pattern where you're actually leaving yourself confused. Most of the time, if you're taught to think like this, and that markets will move like this, and that markets move like this over and over and over again, and you can just keep playing the market back and forth like this, this is one of the easiest and biggest reasons as to why you're very confused, because you are being fed nonstop the idea that as you draw a zone, the zone is meant to hold. This is nonsense. Zones are only one function of the market, and they're actually just a function of understanding whether or not you're in an accumulation or in a distribution. So as you start understanding that, you start realizing that as you have zones pinpointed and those zones fail, they are not indicating failure in regards to your trading system. What they're indicating is that the money that you're looking to enter, the money that you're looking to get behind a specific move, is not being placed behind the specific move. And all that's showing you is one contextual element that is no longer there, and as a result is not worthy to follow. So very simply, ever since this EU failure and its failure to continue holding demand zones to go long from a higher time frame basis, I have simply walked away from this market. And as we take a look at it, you can tell very quickly that regardless of whether you are a short seller or a buyer of this market right here, you are very, very likely getting stopped out on either side. This is the problem. Well, this is the beginning of the problem that some people have, which is I predicted the direction of the market. I know the direction of the market, but I'm never able to make money. There's two sides to that coin. On the one side, maybe the market does begin to give you the true bullish delivery. And at that point, you stop looking for buys and you start forcing shorts. So that's where one of those issues happen where, oh, he's right about the direction because you said it's bullish, but now you're doing the wrong thing, so you're wrong. But on the other hand, you might be right about a direction, whether it be bearish or bullish. However, you're not able to make money because the context of the market is that of a weak to strong hand transfer, which means that because of how much money is being transferred back and forth, and the fact that it's not going to be in a sustain, and there's not going to be sustained moves, means that no matter where your entry is, whether it be long or whether it be short, the odds of any one of those positions, especially if you're risking, normally where you try to have lower stops and you try to protect areas, the odds of you on either side of the market getting a runner or getting something that delivers versus getting something that just stops you out or wicks you out to one side or another or comes to break even is much higher to be broken even or to be stopped out, which is why people that are getting involved on a time frame that isn't 1 minute or lower in this market right now, in this condition, are very likely, and that might be you right now, so hopefully I'm talking to you, are very likely getting stopped out and losing money, and as a result, finding themselves extremely confused by the fact that they just can't get positioned, when all along, Euro US dollar has not been showing its willingness to actually trend, right? So this is one of those issues that come with attaching yourself to a market. You as a trader are not here to attach yourself to a name or a market. It is completely worthless. Different markets, like we just said, undergo different cycles. When money is moving back and forth in one market, it may be marking up or marking down in another. Now, the question is, if you have a market that is simply marking up beautifully or marking down beautifully, would you rather prefer to follow that market, or would you rather prefer to follow a market that might be going in a direction kind of, but doing more so of this back and forth? Well, the answer is always going to be the one that is marking up beautifully and moving in a very beautiful way. But the problem with traders is that as you show up to any given day, especially if your ego is attached to a market, you'll want to follow this to the earth's core, right? You forget that you're here to make money. You forget that you're trading to make money, and you start to think that you're here to prove to the rest of the world and to prove to yourself that you are the EU god and you know how to follow EU. And simply, all I've been doing is I've been sitting on the sidelines going, EU, let me look at it. Has it started delivering any bit of accumulation? No. I'll walk away. And I haven't touched this thing in 12 days. And hopefully, this thing continues to do this for the next few months, right? Because that means that more and more money will be basically averaged in, averaged out, taken out, weak to strong, weak to strong. It's going to give time for the strong money to accumulate or distribute their positions, so then a true trending environment can enter the market. And if it's in tandem with the other sectors or with the other baskets of the markets, and in tandem with the higher time frame, then fantastic. That's going to be a market we can follow. Otherwise, we simply will be someone that stays away from it and lets the dumb money basically play the game of back and forth. Now, what's funny is during these exact same times, Other pairs have been undergoing beautiful movement. One example of that is UJ, and I made multiple videos about UJ already, but as you all know, I shared this exact markup market with you, and we had the initial breaks on that daily, right? Well, initially we had the markup from here, from the 2.0s, reaccumulation model, as I spoke about in my last few videos, the markup, and from that markup within the stage 2, we looked to follow that long, and as we followed it long, we did very well for ourselves. Price began to break down, I stopped following it. Price began to re-break up, I began to follow it, didn't get a move, well, I got a small winner, then it started breaking down again, I stopped following it, and now we've entered a moment where the underlying context, which is bullish, is no longer in tandem with what's happening right now. So again, like EU, I have taken a step back from the UJ pairs. And very simply, I no longer look at them, right? And if we look at some of the UJ pairs here, you can see there's clearly a disconnect. On the intraday, you're looking at a lot of selling going on. The daily remains relatively bullish. So as a result, you can see that reflected in the price action too. You have general bullishness that was delivering beautifully. And at the time when this was delivering, this was around 60 and 70%. So this was easy to follow through. And ever since that has become disconnected, you now have a market where, again, you generally have weak to strong hand transfer occurring. And instead of getting involved in it, I simply take a step back. Come aboard to this week specifically, and we get to silver and gold. And silver, so today I talk about accumulation models with you guys. And very simply, the way that an accumulation model works, to define it for you in a step-by-step process for what you technically want to look for, is you want to, one, let's write this out now for those of you that are still here, about 15 minutes into this video, a little bit later because I showed you guys the webinar clip. So if you're here, now you're going to learn the technical reasons behind what I'm doing here. The number one thing you want to do initially, okay, and this has never changed, is find where the higher time frame money is moving. Now you can do this a number of ways, right? The ways in which that you can do that, as I teach on this channel, is through SSCs of the higher time frame and models, as I teach in the private mentorship, which is basically to look for where's the higher time frame money moving. Is it creating SSCs, whether large SSCs? So again, let me draw this all in case you're brand new to my channel. Is it creating something of this nature? And has it begun some kind of move that's proving prices likely want to continue making a move like so to the next high? Or has it undergone some kind of model, which is what we're going to be talking about today. So number one for identifying where the money may be moving is to identify the higher time frames likely movement, okay? And that's going to take us to step two, which is then, once identified, wait for the lower time frame or your specific time frame. So this is up to you. Again, my personal entry timeframes are right now at the 15-minute. You know, they used to be a 1 second, then they were a 5 second, then a 1 minute. Now I've worked my way up to 15-minute as my just general entry time frame. Just makes my life a lot easier. I'll get on any day and I can check out whether there's a market that's worth entering or not. Right? So once you've identified where the higher time frame money is moving, all of which I'm going to teach you today, then very simply, you want to wait for your lower time frame of your specific time frame. So in this case, it would be a 1 hour, 4 hour, anything above the 15-minute really. To show you an accumulation or distribution model, allow the accumulation / distribution model to be proved, allow it to begin delivering, and at that point you want to assume you're in what we call stage 2. You're in a stage 2 markup or markdown, but very simply all that means is that price is likely to now start a move in that given direction. And 6 is to execute your criteria, because again, criteria, entry criteria, all that stuff only matters if you have the other things taken care of. Every single criteria in the world has points in the market at which it's going to fail. If you don't know what you're doing and you execute during those points, all that you're doing is bleeding yourself dry and you're going to lose all your capital. It's as simple as that. Even if you're risking 0.5%, even if you're risking 1%, doesn't matter what you're risking, you're going to lose all your capital if you don't understand where it's time to look for setups. For instance, as you guys know, my criteria for entry is simply an ICI. This is something a 4th grader could understand. I look for an impulse, a sideways move for a second, or for a little bit, and then I enter on the next upward swing out of that move, protect either under or a little bit under, and look to basically magnify my RR as a result of the fact that by having my stop here. And if price just wants to continue going, I'm already looking at gaining more than I'm ever losing on any given trade. So very simply, if I go and look at some setups that I took this week, right, you can see it. Case in point, before we talk about context, I, C, I, and I simply entered through the uptick here, protect down the low, and look for basically that to occur on the opposite side, and it does. And then I manage my trades, stuff that I'm not going to talk about here right now because there's a lot to this. But again, same thing goes on the next day, right? Simply look for the ICI and enter on the next one, protecting some of the move and looking for it to continue. Doesn't continue, I get a break even, all good. Later in the week, we get, as you know, as I teach on the channel, a reaccumulation model, expecting it to go long. So we get an ICI. As you can see, I'm entering through the high with, again, stop loss protecting only some of the move in anticipation that the money, because it's moving long, will continue to move long and I'll be able to make money out of it. Now there's some management stuff here I'll talk about with the mentorship this Sunday on the 27th. So we're not going to talk about this right here, but simply took another trade, took break even 1.63. Sadly missed out on this move. That's a mistake that I personally made. I'll be talking about that this week as well, but all good. And again, if you were trading London, because this is London, so I was asleep. I was I was asleep, right? But again, you had beautiful ICIs. And again, all of these are phenomenal opportunities to take long. Again, I don't get every opportunity that I take, but these are all opportunities to be taken long on their way up, and beautiful, beautiful money to be made there if you understand what's going on. Now, those are all examples of ICIs. There's nothing complicated about them. It's simply entering on seeing an impulse, a correction, and then entering through the next impulse with the protection and looking to take the profit on the top side. But the problem is if you execute this in areas where the context is not so clear, like for instance on EU or even on silver, when it was doing this, you're going to be losing money, right? If you saw, for instance, this ICI and you entered here, well, that's a loss. If you saw this as an ICI and you entered here, you took that as a loss. If you saw this as an ICI and entered it there, you took it as a loss. If you saw this ICI and tried to enter it here, you took that as likely a loss, until you now hit the jackpot and are now making money. But now you don't know why you're making money. So this is a very important thing to remember about your criteria being good potentially, but you staying as a break-even or losing trader because you don't understand when that criteria should be executed. Now, the criteria that I use, because I'm a trend-based follower, I like to follow trends and get involved in trends, is one that waits for the trend to be very, very likely to continue, right? Where the money's already proven to be moving. And you can see during all this time, not a single trade was taken until price was already proving that one, it was coming out of a certain accumulation, two, it was already moving in accumulation, and three, that it's very likely in a markup. And at that point, that's where I'm looking to get involved, right? So as we look to the daily here very quickly, not daily, sorry. As we go back to, where did I write the stuff down for you guys? I don't know where I wrote it. Nonetheless, what we want to now do is we want to understand what an accumulation model actually is. So very simply, by looking at the mentfx structure indicator, or by simply, so if you go to indicators and type in mentfx structure, you can add that to your chart. Very, very simple. Or you can simply learn the rules that I use to decide, what constitutes a range. And these are things that I teach on this channel as well as in my private mentorship. It's actually very, very simple. It's nothing complicated. It just requires you to understand what's going on and map it out. An accumulation model, so the thing that I'm teaching you to do today, is not the things that you guys want to know, like your little chicky flippies like so. It's not like the label everything perfectly to see the lows cleared so you can take the move and go. It's none of this stuff, okay? I only call it an accumulation model or distribution model or reaccumulation, redistribution, stage 1, stage 2, because Wyckoff was a starting point of my educational journey, and I've taken the important parts of it and refined it into the way that I teach and using the concepts that I teach as well. So simply an accumulation model is nothing more, okay, than prices making continuous. So it can be one of two things for an accumulation model. And then you would just flip this for a distribution model. One is breaks are continuously happening from a left to right perspective to the upside and downside repeatedly, followed by a final bullish break. Okay, so that's what an accumulation is. That's one way to view it. Second way to view an accumulation well, you can have both of these happening at once. It's usually that's what's going to happen. 2 is currently existing ranges are continuously wicked by price. This is absorption, also a form of weak to strong hand transfer. And as I've taught on this channel before, an accumulation model is nothing more than a weak to strong hand transfer. And during that time, you are very likely to lose money if you don't understand what's going on in relation to it being a weak to strong hand transfer. Because again, like I just showed you guys, whether you're getting position long or short, even if you're correct about direction, you're very likely still taking losses because again, you're within that weak to strong hand market where you're going to get a lot more back and forth, and it's not clean sailing journeys because the markup has officially occurred. So this is what an accumulation model is actually defined as. And now let's take a look at what that looks like on silver here. So as we look at silver from a left to right perspective, you can see a number of things, okay? You can see price makes a bearish break, another bearish break right here. So I'm just drawing in the actual structure as you can see it. Another bearish break, then makes a bearish break here, then makes a bullish break up here. Okay, and at the same time as it does that, notice what begins to happen. There are certain bits of wicks that are getting below and above these points until the breaks up. That's all good, but you're now getting some bearish breaks and some bullish breaks. Then you come back to making bearish breaks, another bearish break, another bearish break, and then look what happens. Price goes sideways for a while still being in that bearish break, but now undergoing multiple wicks that are coming out of and not sustaining a move. This is your first indication that you're likely undergoing an accumulation model and that weak to strong hand transfer is currently occurring. Then you get more wicks down below it. Same thing is being happened. Notice how during none of these points here had I for any reason looked to actually get position in a long whatsoever, or even in a short. And notice how even if I did get position in a long or a short, so whether it's short, look at any of these prices, no matter how much I tried to position in a short, whether I'm correct or wrong, none of my trades would have won. Similarly, if I position in a long and try to continue positioning in a long, I mean, you guys can all see firsthand that due to the condition of the market, due to the fact that it's a weak to strong hand transfer, you are still not making money. This is very important because this should slowly start to dwindle away this mindset in your brain that, oh, I'm always losing money, but I'm always right about direction, because again, it does not matter. You need to understand what the market is telling you at any given point. And notice how I'm not attached to any one market that I have here. Instead, I'm looking for the markets that make the most sense to be traded, because again, I'm attached to my models and I'm attached to my entry criteria rather than being attached to any one name. If you're attached to the name, this is not the market for you, right? You should probably go and do like some VIP dog sitting, because then at least as you meet the dog, you know, this is Max, you can get attached to Max and you can be like, I will only babysit Max. I'm VIP for Max. He's my dog. That's the one I want to babysit. Give me good money. Then fine. But this market, right, Euro US dollar, you want to treat it like your Max, but that's not how the market works. The market is cyclical. At different times, your entry is going to be good in different market conditions, or your entry criteria is good in only specific market conditions. But at different times, all asset classes are going to move through market conditions. So if you continuously attach yourself to one, you're consistently going to find yourself break even or losing, because again, you're hoping on luck, or the fact that the market's going to just be in a good condition for when you're trading it, on making money. And that's one of the easiest ways to lose money. So again, you're already seeing that silver is undergoing multiple breaks back and forth. And at the same time, not a single trade has yet been taken on silver despite this occurring. Now, again, we haven't spoken about baskets of goods or anything else yet. We're going to talk about that shortly. So let's continue. So price is continuously going back and forth, down, up, down, down, down. Then it's undergoing this number 2. The currently existing range is now being wicked up and down, up and down. This is weak to strong hand transfer. I don't care if it's to the long side or the short side. I'm waiting for specific things. At this exact point, the reason I'm not taking shorts as well is because my higher time frame is telling me a specific condition of the market as well. What is that condition of the market? Well, take a look. You most recently had prices that were moving long, broke down short, and started breaking long again. And currently, the market exists in a range from this low to this high here. And that came directly from the last down move before the up move, which you can see was refined at some point from right here. Very simply, the last unmitigated point of that entire range. And since then, it's been going sideways for a while. You can see this is a context where a lot of people that trade a higher time frame, like banks and hedge funds, are losing a lot of money if they're looking for trends, because again, trends are not going to sustain in a market condition like this. Then price makes its way down into that SSC range, comes down, and begins to make its run. So now we have a higher time frame that's doing exactly what we expect, where we want to see this ran, which means, you know, all of this above is clouds of liquidity. That's what we want to see ran. That's the long-term model of this. So we'll see where that goes in a few years. But the money's showing you that its underlying condition is long right now. And then on an intermediary scale, if we really want to zoom in on this, then yeah, you have an intermediary break that exists right here. And that comes directly, once again, with my rule. If you follow the rule from this low to this high, and simply since then, if you find the final S&D that was created, price comes, trades into it, trades under the point. Whoops, let me make this light blue. Price trades into the demand zone. Again, notice how it doesn't have to hold it, right? This is something that so many people in mentorships are just like fucking you over with, because you think that every zone is just going to be perfection. It's super easy. You know, that's not how markets move. That's not how orders exist in these zones. You have to understand how money moves and how they're going to be absorbed and taken, and that weak to strong hand is going to occur. Price comes in, absorbs it, and begins to run potentially long. We don't know. All we know is it's hitting a bullish point, which is one of our first steps in identifying whether or not we're even going to look at a potential market for a trade. So price comes into this zone, and as it's in this zone, it begins to undergo this 1 and 2, where there's already been breaks from a left to right that have been going down, up, down. At the same time, you're having breaks that are coming out of currently existing ranges and not sustaining their move. And then again, notice what you have. You have a break to the downside, bearish break. Then you have a break to the top side, bullish break. Then you have a break to the downside again. So now you're starting to see this number 1 happen a lot, okay? These are never going to be the same every single time. This is the idea of the snowflake rule as I teach it. Each accumulation model, notice how I'm not labeling anything. There's going to be staples that they undergo, but there's not like any one thing that you need to expect out of them. Okay? Makes this bearish move, and then notice what happens within this bearish range from this high to that low. Well, you start getting wicks above and below price action. So again, you're seeing number 1 occur, which is that breaks are happening from a left to right perspective, upside and downside repeatedly, okay? And you're having a lot of back and forth. However, as we mentioned here for the accumulation model, the final thing that we need for an accumulation model to be true is a break to the top side. So we're still just waiting, okay? We're still waiting for a break. And then all of a sudden, you now get another break to the top side. Okay, now that's a break to the top side, and that is created by the range. Let's make this a different color for you guys. That is created by the range from this low to this high. That's now created a potential SSC in this market. So what you now have is a potential accumulation model that has come to completion, right? It has been proven by 1 and 2 occurring. It is happening within a higher time frame zone from which you can expect that prices could begin to move long, potentially, right? This is where you saw me release that video to you guys from the webinar, from the private, where I said we'd see longs. Okay, it's made this range. It has traded back into, so this is, let me show you where Friday is before the start of the next week. Boom, this is Friday. So it's traded into that zone. Now, as it's traded into the zone, do you see me taking any buys here? I hope you see that there's no buy positions or anything that I took here. And there's a big reason for that, and that's because we can have the zone fail again. This zone could fail back down, back up, back down for a while, and then make that bullish break that then again creates a zone that then holds, and then we can start to follow it long. We are simply traders that are waiting for the footprint to be shown to us so we can follow the markets and get involved and take our own risk and put risk capital on where it's most optimal, because we start understanding that we are trend followers and we are going to wait for the most optimal scenarios to actually take trades. Okay, let me delete these and these. So you've had 1 and number 2 occur, thereby showing you that accumulation model is there and has been followed by a final break to the top side. Price is traded into the demand zone, again being the final down move before the up move, or simply the final unmitigated move of the actual range. Price is traded into there and began to come in long off of that. Now at this point, you can assume very, very likely that price wants to make a run on this high, and then as we trade and as we teach from a trending environment, continuously higher. And these are the exact same moments at which most traders, including you likely, the person watching this in your mentorship, were looking to go short at this point, at this point, at this point, these points, imbalances, you know, all this stuff. This is where everybody gets short. This is where everyone wants to get short. I don't care who you are and where you're coming from. This is where you're looking to get short, and I know it. That's why you're likely going to get liquidated, right? That's just how that works. And that goes hand in hand with the video I released on my channel recently called The Clouds of Liquidity, okay? So you create this bullish range. Again, this is the part that marks the end of the week. Price trades into it, begins to move long, trades back into it, begins to move long, and then stops. Okay, so that's an accumulation model. Accumulation model is complete. Your assumption now, due to the fact that you have the back and forth and you've had the wick thing occur, is that the model is very likely to be bullish and that you're going to get some bullish delivery. Fantastic. Now comes the baskets of goods. So right now, right here, we are on Friday, 18th of August, and just before that, we had Thursday. If I now go to gold at that same time, gold, Thursday, so right here, Friday, look at the end of the week, which ends right here. Notice the difference in the current markets. One of them, we'll look at silver again, but right now gold, okay, made a breakdown, so it currently exists in this bearish SSC right here, right, and ended the week with simply just a move and then just going sideways. So it's actually ended the week in a bearish range. And at that same time, right, so bearish range, ended bearish, that's it. At that same time, during that same week, right before the end, silver, like we just spoke about, made that bullish break, proving the accumulation model, traded back into the zone and started to go long. This is screaming something at you. This is the big money in the markets telling you exactly where their money is being funneled into and where they want to see the next move occur to. And at the same time, the mentfx sentiment viewer, again, the daily doesn't matter too much. Sometimes you can wait for it to be in effect, right? But the intraday had switched to very, very bullish. And now you have a number of things. The sector, the market of goodies, right? The basket of goodies. You have the silver break long. You have the silver accumulation that's occurring. And you have the relative strength of it all showing the same thing. So at the same time that gold, a market that should be in the same basket as something like silver, making a bearish move, silver fails to make that bearish move and actually ends bullish. And this was all shared before it ever happened. You guys have already seen that, so hopefully that's done and dusted. So now all of a sudden, right, the week starts and the runs begin. Because that's the market that's significantly stronger. It's already shown the relative strength. And at this point, you've entered a condition with the fact that the sentiment tool has now told you the intraday is extremely bullish. The fact that your analysis has proven to you that the accumulation model is there. And again, distribution is very simply the inverse, where you have breaks up and down, up and down, up and down. You're already expecting bearishness, and then price makes a bearish break. And notice again that it didn't happen from the zone perfectly. Notice it's an understanding of how money flows. It's a very, very important thing to understand. I'm probably going to have a masterclass a little bit down the line. The remastered course continues to be taught and holds information like this, but I'm just showing you firsthand that a lot of the things you're learning in many different places of the internet are very, very bad and are going to end up instilling very poor behaviors in you. So what I'm trying to do today right here, even though there's so much information I want to share, is just get you started a little bit with kind of the way that you should start to think. So, silver shows insane relative strength at the same time that gold has made a bearish break and is sustaining a bearish break and can't move higher. Silver makes a bullish break and starts sustaining its bullishness from a bullish area. This is one of the keys, the fact that it's happening from a bullish area and from a bullish expectancy. I don't just guess and go every day. The market's going to show you exactly what it wants to do. Right now, something to remember and to consider is that if silver at the same time was still in a bearish market, well, then everything is just moving the same. There's nothing really much to touch for me. Why isn't it that I was trying to sell silver during this time here or sell gold during this time here? Well, very simply, the reason I'm not going to be trading this market is because the higher time frames already showed me where the money wants to go. So I'm not interested in getting involved in a market where the conditions are suboptimal for my entry criteria. What I'm looking for, as I just outlined for you guys today, is to get involved in the markets where it's as clear as day where the big money is moving the market, and that if I get involved, the likelihood of some kind of follow through that's going to allow me to make a risk to reward, that's going to give me a positive risk to reward, is the trade that I'm going to be getting involved in, right? So very simply, Friday ends, and at that point, the market's already showing bullishness. Friday ends, and at that point, the market's already showing bearishness, but they're not in tandem. So now the basket of goodies are disconnected. One is showing clear bullishness and has shown you accumulation, so you can expect without a shadow of a doubt that the market wants to move long into the coming days or into the coming week. And very simply, as the week begins, price begins its run up, makes a break above this high, which you could also wait for if you wanted to. But again, at that point, it's already proven that it's bullish. And from there, your expectancy is that price wants to explode and trend in a direction. And very simply, as you start getting involved on your trading time frame of choice, whatever it might be, even if it's a 5 minute, you know, there's plenty of options. I'm even going to show you some of the opportunities you had all week here. So once that's already happened and it's now moving, you can wait until bullish breaks come in and simply, this is a fine entry, protect, and look to take it long off an ICI. This could be, for a lot of you, easily, you can risk whatever the fuck you're trying to risk right now on any funded account. Check out mentfunding above for you know, funding and stuff. We also have, you know, we updated our website a little bit, looks a little bit better. Looking to add some more things as we come, so some really cool stuff there, but I'll leave that to the side. This is already a trade that gets you funded, all that fun stuff, right? Just remember that. You can do this on any time frames, okay? It's just a question of understanding the context you're in. I'm trading 15 minutes, so I simply wait. Price makes that ICI, I look to enter through the top. Price makes the next ICI, I look to enter through the top. Price makes the next ICI, I look to enter through the top. This one I failed out on, and then this morning, again, price begins to make its ICI. I entered through the top, protect the low. I begin to partial as my trade goes into profit, and sadly, super sadly, it comes to wick out my stop loss, my trailed stop here before making the big move. That's part of the game. That can happen. Now, again, at this point, I would not be entering anymore. I'd be waiting for more of a reset, but that's something for the later videos, for talking in the mentorship to help students there, all that fun stuff. But this is how you frame out a trade. This is how you frame out a framework. This is how you get attached to the conditions and to the setup rather than get attached to the market. This is how you don't become that VIP dog sitter that can only sit max, right? Because you're attached to max. This is how you understand how markets move, how they move cyclically, how money changes hands, and how to get involved in the ones that are the cleanest. And as a result, you start seeing stuff like what we see with our team here, where you know, you have Team GJ here writing this up, simply just a nice little ICI that he took. Again, there's so many opportunities like these every single day. It's almost impossible to think about. So good for him. You know, you have guys on GJ, lazy day for him. He's taking, he's looking for the gold buy stop. You know, you have Deku who can't even believe that this is the case, right? But he entered this on a 1 hour, because again, this is happening on all time frames. Simply this ICI, and then the next ICI, he entered it through the top, protected the low. And again, similarly, the upside potential will always negate the downside risk. And over time, you're always going to guarantee to make money. Again, this is no guarantee for you, but I'm saying that if you've tested your system and you can get involved in the best context, you're guaranteeing a way for you to make money. And very simply, he's proving to himself firsthand that he'll be able to do this over and over and over again, because that's how markets move. And it's an absolutely beautiful thing. And he said it himself. He started to see what he's actually capable of because he's participating in the competition. And if you guys don't know what that is, you don't even have to pay for it. It's completely free. Head over to mentfunding.com. Simply click on competitions up here. Just click on competitions and register yourself in this competition or the one that's coming up in the next month. And just allow yourself to trade within a demo environment, get used to it. You know, it's one of the best ways that you can start getting used to what happens in the markets, how to properly risk, all this stuff for completely free. And you're going to start seeing firsthand for yourself how these concepts over and over and over again repeat, and how I've used the same concepts for years now through my teaching, before privately for about, I think, currently, how long have I been teaching? So 4.5 years privately and three years publicly in regards to YouTube and my private mentorship. And this is how, again, you guys saw me predict this move here through the same exact concepts years ago, back in 2022 or a year ago, and how you're seeing the same thing happen again this year from these runs, and now hopefully these runs, because it's the same thing over and over and over again. We just look and stalk for the best context, and then we start getting involved in them. And as they begin to provide us delivery, we simply look to enter and never look back. All right, guys, I hope this video taught you something. A little bit long, I know, but that's how it is here at mentfx. I have so much to teach. I don't necessarily know exactly where I should start with it. So hopefully today you learned a little bit about accumulations. You learned to see that this is all done prior, and you saw firsthand how we go over this stuff and predict it in the webinar. And again, congratulations to all of you that are doing very well. Check out mentfunding, mentfx, all that fun stuff. Use the tool. It's one of the best tools you'll ever have access to, and I'll see you all in the next video. Thank you.